Well, good morning and welcome to another economics webinar. This is Robert Mullen, Director of Agronomy. This is going to be a little bit different. I feel like I say that every time we have a webinar. This is going to be a different topic. This isn't going to be statistics. Well, maybe a little bit. That's really at the discretion of Mark and Yao. It's going to be talking about the economic conditions that we see out across the ag landscape. It's going to talk about the fertilizer industry. It's going to talk about ag in general across the globe. We couldn't ask for two better presenters for the group. I've heard both of these gentlemen speak a number of times. Always enjoy it. So with that, I'm going to turn it over to Mark and to Yao. You'll hear my voice at the end when we get into the Q&A section. We're going to take about 45, 50 minutes, leave about 10 to 15 minutes for Q&A. I suspect there's going to be a lot of questions given the economic realities we see out there in the ag space. So with that, Mark, Yao, it's all yours.
Great. Thanks for having us today. And, it's funny, we were talking, it's been almost exactly 1 year since we've met with this group. And I think it's great to catch up with everyone again here because it has been such a dynamic 2021 and a lot has been going on in commodity markets as well as really the ag industry as a whole. So hopefully, and Robert, maybe you could confirm that the screen's coming through here.
It is.
Great. So, like I said, it's been a really dynamic year, and what a difference 1 year has really made to the industry as a whole. We've seen crop prices hit multi-year highs on below trend production and rebounding demand in 2021. And with that, we've seen, some food price inflation in the marketplace. FAO food price index hit a 10-year high, driven by some of these high crop prices that we've seen in the market. And I think the market is doing its job to start to attract production into 2022 and incentivize some area and hopefully maximize production to help alleviate some of these market dynamics that we're seeing. At the same time as this increase in crop prices, we've also seen some major supply chain disruptions for key crop nutrients and chemicals, which has certainly led to higher prices on the input side of things. And as we head into 2022, I think it creates a situation that we haven't seen for a few years, certainly, where these fueling input costs paired with the high crop prices are certainly going to create some decisions for growers out there that could be challenging. And I think having these sort of discussions hopefully helps answer some of those questions as we head into the 2022 growing year. So I'm going to kick us off and talk through some of the ag fundamentals, and then I'll pass it over to my peer Yao, who will cover the fertilizer market dynamics. So I thought I'd start with the crop prices and look at the historical trends here. And so these are some of the major row crops in the marketplace in the US and South America. And we've got corn, soy, cotton, wheat, Brazilian soybeans, and palm oil prices here. And when we look at the historical trend of the realized prices, and we think about where we landed in 2021, growers, I think, ended up receiving some of the better returns that they've had in really the better part of a decade in many cases. And I think growers are holding on to some cash reserves that they're ready to invest into that 2022 crop. And if we look at the 2022 futures, which is the bar on the right for all of these little charts here, you can see that really prices have held on pretty strong heading into the next calendar year. And we look forward to seeing how these prices change dynamically. But I think where prices are today, you'd recognize that the margins for growers may actually be fairly profitable at the moment, or at least offering a reasonable return in most cases. So we see this strong prices across the board, I think really incentivizing acreage, creating some competition for acreage into 2022, assuming there's some supportive weather into the North American spring. And I think is going to create some opportunities as well as some challenges for growers in making some decisions in the marketplace. Now, fundamentally, these crop prices are really driven by the domestic and international supply and demand fundamentals that we've seen. And really what we saw over the last couple of years is some below trend production for some of these major row crops. And it's been paired with some of the best demand I think we've seen, certainly in the trade marketplace in several years. So When we look at corn and soybeans on this chart for the United States, we see quite tight ending stocks and stocks to use ratios relative to recent years. And I'd point us as well to that gray line on these charts, which is the global stocks to use ratio. And you'll notice as well, that's hit multi-year lows as well. So when we put this picture into place here, this strong demand that we've seen in the marketplace, whether it's for biofuels or Chinese imports, combined with not achieving maybe trend yields the last couple of years, there's really been a development of tightness, which has provided that fundamental support to those corn and soybean prices that we've seen, which are trading above $5 and above $12 into 2022. Touching a little deeper on the demand side for the US, and I think a big driver really has been the trade dynamics over the last couple of years, which we've seen supported primarily by China coming to the marketplace like they've never come before for the US crop. The phase one deal signed in 2020, which has lasted the last couple of years, has really set a benchmark for trade between the two countries. And China, I think, has really purchased record levels for the last couple of years. And I'll point us to the old crop, 2021 crop, which is that green line at the top, which it was an exceptional export pace, which was set the best in 20 years and really the best ever for corn and soybeans, which really contributed to those tight domestic supply and demand situations that we see in the United States. The black line on these charts is the average pace of trade over the last 20 years. And what you'll notice is the blue line is the new crop, which is coming out of the ground at the moment. And we see actually some pretty strong demand in the marketplace still for corn exports. A little bit behind last year's pace, but we did have some challenges, I think, back to weather specifically, when we think of trying to move product out of the Gulf here in the fall. So I think that certainly played a role in that dynamic. The one thing to watch, I think, heading into 2022 is the soybean export pace is not nearly as high as it was last year. It's much closer to average. We may see some purchases here that help that out. It is slightly above average, but I think that is one thing that is a little bit different versus last year in terms of how tight the S&D is, and we do see a little bit of a loosening over the last couple of USDA reports in the soybean ending stocks. I think is in part as a result of this. Now, while we're talking about ending stocks and stocks to use ratios, I did want to touch on the Western Canadian story, I think, for some of our viewers who are in Western Canada, and certainly that's my backyard. And I wanted to point to canola ending stocks and stocks to use ratios, as well as where wheat stocks to use ratios are at the moment. And I think what we're seeing here is more fuel to the fire of those crop price stories that I was talking about earlier. If we look at the canola chart on the left, near record low ending stocks and stocks to use ratios for canola, both domestically and internationally when we look at the global stocks to use ratio. And we've seen canola prices out into 2022 over 17 bucks a bushel at the moment on a Canadian dollar perspective. So very strong prices heading into 2022. Obviously, much like the northern plains in the US, we did see drought, pretty extensive drought in Western Canada, which impacted yields and created some of this tightness that we're seeing in the marketplace. And that story holds true for wheat as well. And, wheat prices have really been, I think, the part of the big driver in the grain prices that we've seen through Q4 of 2021. And part of it clearly is the tight North American stock situation, as you can see in that chart on the right. But global stocks to use ratios have hit a 5-year low. And this is paired at this period of time where we have some export quotas coming out of Russia, the world's largest wheat exporter, because of the challenges they had with production in 2021, combined with some strong demand in the marketplace, near record wheat imports in China throughout the year. But at the same time, we're starting to see North African and Middle Eastern countries start to come to the marketplace pretty heavily, looking to stockpile on their wheat levels heading into 2022. And so there really is some tight dynamics in that crop as well. So I think we're generally painting a picture here when we look into the supply and demand scenarios in the domestic marketplace as well as the global marketplace that fundamentally support prices heading into next year. So I want to move away from North America now and talk about some of the other countries and regions that I think are playing a big role both at the moment and through the last year. And China, first and foremost, is one I do want to touch on because it's been such a big driver of demand over the last couple of years here. And the big driver in my mind is that chart on the left, and that is China's inability to produce as much grains as they use. And that chart there shows China's grain production surplus deficit. And as we look historically, China was producing plenty of grains, but over the last couple of years, they've started to produce less than what they need in country and developed really a 90 million metric ton deficit over the last 3 growing seasons, and is projected to, with the current crop as well, be at quite a deficit. And we see this as really a structural change in the marketplace in at least the near term, as we look to what that means for import demand from China. China has to really meet domestic consumption levels, and they're doing that by coming to the marketplace and purchasing well above historical levels of all major grains, and in many cases oil seeds as well. As we look to that chart in the bottom right, I think you can see that the last couple of growing seasons, the significant import demand that China's had for soybeans, corn, and wheat in particular. I know certainly when we think of what's the big driver behind this story, we think back to the African swine fever epidemic that has faced China the last couple of years, and they've been rebuilding that hog herd. Generally, I think China's done a pretty good job of getting those hog herd numbers back to a normal level. But at the same point in time, there is still some work to be done there as they look to modernize the production in country and get that herd back to normal distributions. And so we do feel that heading forward here, we might continue to see a significant deficit in terms of production for China, which will hopefully get them coming to the marketplace pretty aggressively over the next growing season. Certainly one thing we're going to have to watch with China, though, is the end of the phase 1 deal here at the end of this year. And so China and the US have to come back to the drawing board and understand what the trade relationship looks like heading into 2022. And so that's certainly something we'll be keeping a close eye on heading into next year, and certainly through the first half of next year as well. Now, we talked about on that opening slide how we've seen some of the input prices increase significantly for the 2022 crop. And I think a big part of that is the crop chemical situation in the marketplace. And China is a big portion of that story. We look at the energy costs in China, they've increased significantly, and that's the fundamental input for creating those chemicals in China. Ocean freight rates are significantly higher. So when we look at moving the product from China to the United States, that's a significant cost headwind that a lot of those producers are facing. But I think the clear story here is that big chart on the right, which is the Chinese chemical price index of imports into the US. And you can see it's at an all-time high. And it's really driven by those fundamental cost challenges that the Chinese producers facing, but at the same time, China is doing making some changes in-house around how they manage greenhouse gas emissions. And certainly some of the chemical producers in China, I think, have had reduced accessibility to energy and reduced production as a result of that. And so we have seen some tightness in some of these key active ingredients as well heading into next year. And so that's been a driver of some of these large price increases that we've seen in the chemical shelf. And I think will be a headwind that many growers are going to have to, I think, face heading into 2022. So moving to the southern hemispheres, that's the area doing the biggest part of the growing at the moment, and certainly a hot topic for the markets. And I'll focus here on Brazil because a huge story here heading into into the current crop that's coming out of the ground at the moment. Top left chart there, I think, tells the story almost in one chart, and it's the record prices that growers are getting for corn and soybeans in Brazil. And that's really incentivizing them to increase acreage and increase the inputs on the crop and maximize production heading into this growing season. Our view certainly is that there is a significant increase in area, both for soybeans and likely for the second corn crop, which should lead to a big rebound in production next year. You look at the chart on the right, which shows the production in the bar charts there, and you'll notice that the last crop was shrunk in size. And they really faced some weather challenges last year that resulted in underproduction, particularly for corn. So looking to rebound this year for that crop in Brazil. I think the big story that could drive that is that chart on the bottom left, and that's the planting pace that we saw for soybeans this year, and near record pace for the soybeans getting into the ground, which is key for that second crop of corn. It extends the growing season window for when growers can put that corn into the ground. They can hopefully get themselves an ideal window and get good weather that will allow them to get the yields they would like to see out of that crop. And so we'll start to get some clarity into how much production is coming out of the ground here in Brazil come early Q1 2022, but our expectations is that we do see a rebound out of country there. The one thing we're watching for South America in general is the La Nina weather pattern that continues this year as we saw last year. That's that cold water off of the west coast of South America. And what that traditionally brings is some dry, hot weather to southern parts of Brazil, the major growing regions in Argentina, and potentially reduces the production, particularly in Q1 2022 for that second corn crop. In Brazil. And so we'll be keeping a close eye to see how that weather pattern develops and if that becomes a headwind for growers in the region. At the same time, I think Australia has been a big story and certainly was maybe the most interesting story in the recent WASDE report that came out last week. They've had really good weather the last couple of years after some pretty significant drought when we think back to 18 and 19. And for their winter crop, which is headlined by major grains and oil seeds and is being harvested at the moment, about 65 to 70% harvested at the moment in Australia, they're looking at a record wheat crop and a record canola crop coming out of the ground here in Australia. So I think that's very exciting to the Australian grower for sure, especially with where prices are at the moment. And I think much needed in the tight S&D environment that we're seeing globally. One thing, certainly, if you look at that map on the right-hand side there's been a lot of rain in the major growing regions in Australia, and there's some questions about the quality of the crop as a result of that. So more to come as that crop comes out of the ground and starts to get marketed more heavily. But I think the growers are pretty pleased with the fact that they might get some record production out of Australia this year. And certainly I think expect Australia to continue to invest heavily after a couple of really good growing seasons in Australia. Looking for a big rebound in both area and production for their summer crop, which goes in here in our North American winter. But certainly it's not a huge crop relative to the global supply and demand situation in the world. So nothing too major there. So talked pretty heavily about global supply and demand, where prices are today, and I'd like to bring that back to what we think is, the experience for a trend farm, the average farm in North America. On the left-hand side are the key crop cash margins for some of the major row crops in North America. And you see US corn, US soybeans, wheat, cotton, Western Canadian canola, as well as Brazilian soybeans there. And I think I mentioned the higher costs for production heading into 2022 as we think of where fertilizer prices, chemical prices, even the cost of things like land rent are and fuel heading into 2022. And so our expectation is even with these high prices that we're seeing in the marketplace, that there is a little bit of depreciation in terms of returns year over year for the 2022 crop relative to 2021. But still significantly higher than perhaps historical returns or average returns. The chart on the right, I think, does a good job of sort of explaining where we see these costs coming for the grower. And this is on a per bushel basis for US corn. And you see the green line is the price of corn. The stacks there, and I primarily point to the gray, are the costs, but the gray is the fertilizer costs. And what you see is in all of those stacks heading into 2022 is a widening of those stacks. So the costs are increasing by shelf heading into 2022, and something that the grower is certainly facing. But I would point that combined, those stacks still remain well below where the cash prices for corn are. And so the return or the margin we expect should be reasonable, certainly compared to the historical returns, as you can see, looking at 2013 to 2019 for that crop. The last chart I wanted to point to today was, where are fertilizer economics for the grower at the moment, and where is fertilizer affordability? And I think it really does depend on the farm and the region where the grower is. And this to us is sort of our estimate of maybe the average farm facing trend yields in the United States. And this is for corn growing. And so I wanted to point to potash costs and phosphate costs here. And this is on a how many bushels per acre of corn to purchase 1 acre of fertilizer application for potash and phosphate. And the squiggly lines there are the prices for the potash and phosphate. And as you can see, certainly trending at well above average levels heading into 2022, which I don't think is a surprise based on what we're seeing in the fertilizer markets. But I think the important takeaway that I'd point to on this slide is the dark blue line that strips across the top. And that is the average yield gain from making that fertilizer application. And for us, we see that as where prices are today relative to that yield gain, is that there still is an incentive to make those applications for many growers across the US. And we've seen a pretty open fall window this year and strong demand as a result of that. And I think that points to, I think directionally where we expect the marketplace's demand to be heading into 2022. One thing I would caveat this is, like I said earlier, this is not every farm, and certainly I think where marginal land is, and if you're not getting, trend yields in the United States, that perhaps some of these decisions have been made for you, and I think there will be some changes in mix as a result of, crop mix as a result of where prices are today, and for some of those fields. So I'll pause there. I think we've done a good job of hopefully describing where the ag fundamentals are here, both internationally, domestically, and what that means in our view for the grower in the major markets we operate in. And I'll pass over to Yao now to discuss really the fertilizer supply and demand. And I know I'm sharing screen, so Yao, just give me a shout when you want me to switch slides.
Good. Good morning, everyone, and thanks for having us here. And it's a great opportunity to share some thoughts that we have and some of the views we have on the global fertilizer market. And I think what Mark has just laid out or discussed is a pretty positive agriculture fundamentals that we've seen in the last year and a half. And if you look at the global fertilizer market, and in particular fertilizer prices, they started increasing since the second half of 2020, and then that strong momentum has absolutely carried over into most of the 2021. And then so far in 2021, fertilizer prices have been on the rising trajectories, and we actually have seen many fertilizer commodities, potash, nitrogen, and phosphate prices have more than doubled or even more than tripled compared to the same time last year. And then I have to say that the magnitude and the degree of the fertilizer price increase has exceeded the expectations of many market participants, including some of the consultants out there. So, but I think the market's just got caught up in this perfect storm of very tight, very strong demand, but also very tight supply situations out there. Overall, I think it's still fair to say that it's largely a demand-driven story, given how heavy the fertilizer purchases have been in some of the key spot markets in the U.S., not just in the U.S., but also in some offshore markets in Brazil and the Southeast Asian countries. And of course, as you know, that food security and safety remains a top priority for most of the countries out there, particularly during the COVID-19 period. Mark talked about the great effort that the Chinese government is putting on increasing the domestic food production in the country, but we've seen similar measures and similar efforts being made in many other developing countries, India and many other developing countries in Asia as well. So, and when it comes to increasing food production and crop production, of course, flatter is a big part of that equation. So that has been also supporting flatter demand in many of the jurisdictions that we've seen. Besides the strong demand, we're seeing another thing we've been seeing is massive amount of supply disruptions so far in 2021. We have had a lot of planned maintenance turnaround times for some of the plants, but also we have had a lot unexpected weather-related shutdowns. If you recall, we had a colder than normal, had that cold snap earlier this year in the United States. That has knocked off quite a few 100,000 tons nitrogen production from there. And also in August, we had this Hurricane Ida, which also impacted U.S. domestic nitrogen and phosphate operations. And then also in many other parts of the world, in Indonesia and in Saudi Arabia, we have had a lot of technical related turnarounds. And all those unexpected turnarounds and combined with some of the restrictive export policies, particularly recently announced from China and also Russia, they all contributed to these supply disruptions we've seen so far this year. And then that, again, combined with a strong demand, all contributing to this big wave of price increase we've seen. So I would say those are the major reasons why we've seen flatter prices increasing more than expected in 2021. Quickly for potash market, in 2021, we expect the global potash demand will be reaching a record of 70 million tons. And so far this year, we have seen record shipments to some of the key markets like US. In North America, this year, I think we're expecting close to 12 million tons of total deliveries, which is an all-time record in there. And then for Brazil, we are expecting another record of shipments well over 12 million tons in the country again. And then also we're seeing very strong demand to some of the Southeast Asian countries, including Malaysia and Indonesia, supported by the very favorable palm oil prices in those regions. So yeah, we have seen record demand in most of those spot markets. And for China and India, even though the agriculture fundamentals are fairly supportive, but as you know, those are the typical contract potash markets. And the contract settlement and prices, they settled earlier this year, have been significantly below the prices we've seen in the spot markets. For example, for China, if you recall, the contract settlement prices earlier this year was about $247. And for India, it was $280. Those prices are significantly lower compared to the $600 sold in other Asian markets, and also close to $800 potash prices we're seeing in Brazil today. So that simply means that lower contract prices have provided very little or very limited incentives or willingness for the global potash suppliers to ship products to those regions. And that has led to very reduced volumes of imports, which we believe those reduced imports will ultimately lead to very depleted inventory situations in both China and in India at the end of this year, and which again will provide a tailwind for demand for 2022. But overall, in most of the key spot markets, we have seen record shipment this year, making the global potash shipments another record year in there. For 2022, our current forecast is calling for a fairly stable demand environment, assuming there will be very minimal supply disruptions from Belarus-Cali. But at the same time, as you probably heard, that the concerns on Belarus-Cali supply is a real concern, given the sanctions from EU and then also from US at the moment. So if those sanctions continue to escalate, and then if we see more disruptions from Belarus-Cali supply, then we believe the total potash availabilities to the farmers will be limited in 2022, and then that could result in lower than expected demand in 2022. Largely because of lack of supply out there. So that I would say that's a main factor to watch on the demand side in 2022. Just quickly touching on the supply picture of the potash industry. In 2020, we had a pretty tight supply demand year already. And I know most of the potash suppliers have sold more products than produced in 2020. That includes Uralkali in Russia, Mosaic, and even including ourselves. I know that we drew down our inventories by quite a few 100,000 tons in 2020. So that simply means that most of the global potash suppliers entered 2021 with very limited inventories at the mine sites. And in 2021, we believe most of the producers are capped out at the current operational capabilities. And so far, we have seen very limited production increases in 2021 level. And we actually have even seen some declines at some of the mine sites. As you're probably aware of, that Mosaic, they decided to shut down their Q1 and Q2 Esterhazy potash mines about 9 months earlier than anticipated because of the worsening inflow issues at the mine sites. So that has resulted somewhere between 500 to 700,000 tons production decline this year in 2021 compared to their initial plan. And we as Nutrien, as soon as we noticed there was a market gap, supply gap in the market, we decided to increase our production, potash production by about 1 million tons compared to the initial plan earlier this year to meet the supply gap in the market and also to meet the increasing demand from our customers in there. So really, Nutrien is the only producer out there in 2021 who was able to bring on significant tons to meet the supply gap in the marketplace. And then you may also notice that for Belarus, we still show a slight production increase this year. That's largely because they're in the process of ramping up their new greenfield project, the Petrichol project, which is about 1.5 million tons in there. And but again, you know that I still want to say that the sanctions on Belarus that continue to be a key factor to watch for the remainder of this year, and more importantly, going into 2022 to see how the sanctions will impact their operations down the road. Next slide, please, Mark. Thank you. And then this slide, I just want to give you more color and details in terms of the Belarus supply situations. And again, as I mentioned, so far this year in 2021, we haven't seen major physical impact on their shipments or their production yet. But I have to say that that's going to continue to be an ongoing concern in terms of to what degree the supply from BPC or from Belarus will be impacted from the sanctions. Particularly, as you probably heard, that the U.S. administration has recently strengthened or sharpened the sanctions against Belarus. Now they're including BPC, who is the marketing arm for Belarusian potash sector, or Belarus, to be directly under the sanctions. And we have heard, because of the strengthened sanctions against the BPC, a lot of the global potash buyers, you know, with or within the U.S., but also outside of the U.S., you know, the Gavilon, which is a major potash buyer for the Belarus product in the past, and also Yara, who is a major potash buyer for Europe and for Brazil, they all expressed concerns about doing business with Belarus on an ongoing forward basis. So we have heard those hesitations from the global potash buyers. And also, we know that EU is also in the process of strengthening the sanctions against Belarus, and particularly from Germany. Germany is particularly pushing for more restrictive sanctions against Belarus down the road. So even though for now we haven't seen major impact on their shipments yet, I have to say that that's going to be an ongoing concern. And I have seen more and more potash buyers might not be able to do business with the Belarus going forward because of those concerns, and also some US dollar related issues with payments issues and also logistic issues. So, and as you can see, Belarus historically played a very big role in the global potash trade. They would export somewhere between 11 to 12 million tons of potash every year. And they have a pretty large presence in nearly all the markets that you can see here in Brazil, US, China, India, other Asia, and many other jurisdictions too. So even though in 2022, we could potentially see some increased production from other suppliers, particularly from Mosaic, as they continue to ramp up their Q3 potash Esterhazy mine and also bring Clancy back, and also may see another a couple 100,000 tons in incremental production from Russia, particularly from Uralkali, as they continue to ramp up their greenfield projects down there. But I'll say those incremental tons are nowhere near the tons that are needed to fill the market gap if something more happened with the Belarus-Cali supply out there. So again, I'll say that the BPC supply situation will continue to be a key factor for us to watch for the remainder of 2021 and then going into 2022 there. Quickly looking at the inventory situations in the key jurisdictions, I would say this is probably one of the hot topics that we get asked a lot in terms of inventory levels in the key jurisdictions. And then you can clearly see that for both China and India, they have been drawing down their potash inventories quite significantly over the last year or so. Again, because of the very strong domestic consumption, but at the same time, very reduced import volumes at the same time. And for China, you can see that they're sitting on pretty low inventories at the moment at the ports and then also within the country. And we know that Chinese government has recently announced that they're going to use the 1.5 million tons strategic inventories to help with the consumption for the fall application season and also potentially for the spring application season next year. You know, for people who are not familiar with that 1.5 million tons strategic inventories, that's part of the inventories that the Chinese government built a few years ago, and it's more designed to handle the emerging supply situations. And over the last 6 years, they've been only using it twice. So this is the second time they decided to use it. So that's really telling us that China is really sitting on a very tight inventories at the moment. And a very similar situation for India. As you can see, India is sitting on dangerously low inventories at the moment, just around 300,000 tons within the country. And India is a typical contract market, but because of lack of supply at the moment, some of the NPK producers actually have to come to the spot markets and trying to secure some tons from the spot markets in order to support their domestic NPK operations. And even for Brazil, as I mentioned, we're going to have a record year of shipment in Brazil this year, well over 12 million tons. But inventories haven't really increased. It's still fairly at a stable level, about 1.6 million tons, making us believe that whatever was purchased in Brazil so far this year was pretty much put in the ground and consumed. So don't really see much inventories in that country as well. Next slide, please, Mark. And just quickly touch on the North American potash situation again. You know, if you see this chart, we have had 2 consecutive years of below trend consumption years in 2018. In 2018-19 fertilizer year and also 2019-20 fertilizer year. If you recall, we had some very unfavorable weather conditions in those 2 years, impacting the potash applications in those years. That's why we had those two consecutive of below trend years. However, in 2020 and 2021 fertilizer year, we saw a big rebound in terms of potash consumption, and largely supported by very favorable corn soybean prices and also very favorable weather conditions combined with increased crop acreage during that fertilizer year. And we heard from our customers that potash application rates have increased by somewhere between 15 to 20% in that year, again, supported by those very favorable crop economics. And in 2021, 2022, the current fertilizer year, we believe the potash demand will continue to be very strong in this fertilizer year, again, supported by the very good crop prices and the cash margins, as Mark outlined in his agriculture section there. But again, to echo what Mark said, we could potentially see some pullback, particularly on some of the marginal land. I would say for most part of the U.S., you know, potash continue to represent a very good investment in terms of providing farmers with a good yield and benefit on that. But on some of the marginal land, we could potentially see a pullback because of the increased cost for those farmers. So, but overall, we believe the demand will continue to be strong compared to historic levels in 2021 and 2022 fertilizer year. And Mark, if you can quickly go back, I just want to touch on the inventory side. And then, yeah, on the inventory side, in 2020, at the end of 2020, 2021 fertilizer year, we believe, given the strong consumption we've seen, we had a very limited inventories at the end of the fertilizer year. And then also for this current fertilizer year, we have had a pretty strong fall application season. If you recall, we had a pretty advanced harvest on the crops. So that really left the farmers with abundant time for potash application. And we believe we had a pretty historically strong potash application season. So that'll make us believe that we're going to finish this 2021 calendar year with also very limited inventories, which will bode well for the strong potash sales and demand for 2022. So, looking at all the inventory situations, we talk about China, India, very depleted inventory situations out there, and then also very stable inventory situations in Brazil and the US. And then I think that's one of the major difference if you trying to compare the current market environment versus 2008. I know many people out there trying to compare the current market situations versus 2008. I would say this is probably one of the biggest difference. At the end of 2008, we have seen a lot of inventory buildups in many of the jurisdictions in China, India. But I think for this market, a lot of people, they have learned a lesson from 2008, and it's more of a hand-to-mouth purchasing behaviors in the last few months, I would say. And so from inventory standpoint, we haven't really seen excessive inventory buildups in the major regions. And I would say that's probably more of a healthier market conditions we're seeing today compared to 2008, if you will. Next slide, please. Thanks, Mark. Just quickly switching gears to the global nitrogen market. And when it comes to nitrogen market, of course, energy is a big component of that story. And energy prices has been a hot topic in the last few months. And you can clearly see that both natural gas prices in Europe and also coal prices in China have been increasing quite tremendously since the beginning of 2021, particularly for natural gas prices in Europe, which averaged well above $30 over the last month or two. This morning when I checked the European natural gas prices, it was as high as $38 per million BTU. So that compares to roughly about $3 or $4 per million BTU at the same time last year. So that's a major change in terms of the natural gas prices in Europe. And we talk about over $30 per million BTU natural gas prices in Europe and translate that into ammonia cash cost in that region. It's well over $1,000 per ton of ammonia production cost. And then, taking this morning's gas cost, $38, that's simply putting the ammonia cash cost at around $1,400 per ton. So, given that level of cash cost in Europe, it simply didn't make any economic sense for those assets to continue operating. And we've seen massive amount of ammonia capacity shutdowns in Europe because they're simply losing money. And that has instantly tightened the global nitrogen supply, not just for ammonia, but for a wide range of nitrogen products, including ammonia, urea, ammonium nitrate, and UAN, and many other downstream products. And going forward, we believe that the natural gas prices will continue to be high through the winter months. Particularly, Mark talked about the La Nina weather patterns and the potential weather implications, which is going to cause some drier than normal weather patterns in southern Brazil and also Argentina. But at the same time, it also means that we're going to have a greater risks of colder than normal weather conditions in the northern hemisphere, particularly in Europe. So that means that we're going to have a lot of demand for natural gas for heating purpose for residential use. So for that, because of that potential strong demand for natural gas, and then also the tight supply on the LNG side, we believe European natural gas prices will continue to be high through the winter months. It might come off next spring and summer once the winter heating season is done, but still the forward curve suggests a very high floor prices for natural gas prices, which will again support a much higher floor prices for nitrogen operations and the nitrogen prices going into 2022. So, but I would say, yeah, natural gas prices and coal prices in China will continue to be the major factor we're watching, and the potential implications on the supply side of nitrogen. Quickly switching to the global urea market, and as you can see, we're displaying China and India, particularly here, because China is still the largest swing producer, urea producer, and the marginal producer, if you call, to the global nitrogen market. And India at the same time is the largest urea importer in the global market. So what's happening in China and India will a lot of times determine the directions in the global urea market. And as you can see for China here, the exports out of China have been pretty high so far this year in 2021. China exported about 4.8 million tons of urea in the first 10 months of this year, largely attracted by the very high international prices. However, for the remainder of 2021 and also potentially for the first half of 2022, we expect to see very limited exports out of China, largely because of the restrictive export policies that the government put in place a couple months ago. So, and because of that reason, we believe we're going to see very limited supply out of China. And then I would say that's probably one of the biggest shock in the marketplace from the last couple of months. And because of that lack of supply out of China, India, which is the largest urea importer in the global market, and then they import a lot of tons from China, they may not necessarily get all the tons they will need for the upcoming planting season. So initially, we believe that India will import roughly about 10 million tons in 2021, very similar levels compared to the record level we saw last year, about 10.3 million tons. But because of the lack of supply out of China, they may not get all the tons they want. And then we think they can only import somewhere between 8.5 and 9.5 million tons. The only viable option they can go to right now is Middle East, trying to get some tons out there. And you can really tell that Indian importers, from the recent importer tenders, they were paying close to $1,000 per ton of urea from the Middle East suppliers, just in order to secure more tons for their upcoming planting season. So overall, I would say the lack of supply from China because of the government policies for the remainder of this year and also for the first half of 2022. At the same time, there's still significant pent-up demand from India. Together, that'll continue to support the urea market for the rest of this year and potentially going to 2022. Just more specifically on the Chinese restrictive export policies, which has been I wouldn't say the game changer, but it's really a major shock on the supply side for both nitrogen and phosphate out there. The reason for that is the Chinese government has been really concerned about food inflation within the country. Even though China is a major exporter of urea and DAP, MAP, the Chinese farmers were facing record high urea prices and then also near record high DAP, MAP prices for most part of 2021. So that has been a major concern for the Chinese government. And in order to make sure there will be more supply for the domestic farmers and then also stabilize domestic fertilizer prices, the Chinese government came to the market about 2 months ago at the end of September and basically announced that all major nitrogen and phosphate suppliers should stop exporting fertilizers. At the same time, they demanded all the major ports in China to stop receiving exports, to stop receiving products for export purpose, and also implemented very restrictive product inspection procedures out there. So that's basically shutting the door for urea and also DAP, MAP exports for Chinese producers for the rest of 2021. And also the policy will be most likely remain in place for the first half of 2022 out there. And if you look at the magnitude of Chinese supply into the global market, historically, China would supply roughly about 2 million tons or export about 2 million tons of urea and also 4 million tons of DAP, MAP into the global market in the first half of a calendar year. So that's basically removing those 2 million tons urea and 4 million tons phosphate from the global market, which has instantly tightened the fundamentals and supply fundamentals and also the momentum in the marketplace. And it's not just China, and also a few weeks ago, Russian government also came to the market and announced very similar policies, restricting the fertilizer exports of Russian producers into the global market. I would say the Russian announcement is probably not as impactful as what we saw from the China one, but still that would put a limit how much Russian suppliers can kind of supply to the global market in there. So all the announcements from China and Russia have instantly tightened the global market, and then we think that'll continue to continue to make the supply tight for both urea and DAP MAP going into the first half of 2022 there. So on the phosphate side, one thing I want to quickly highlight, particularly for the US market, is we have seen some significant trade pattern changes, particularly post the countervailing duties are implemented against Morocco and Russia. On the right-hand side chart, you can clearly see that Morocco and Russia used to be the two major suppliers of DAP MAP and the global market. But because of the countervailing duties, it didn't really make economic sense for them to continue shipping to the market. And instead, the US has been getting a lot of products from the non-traditional suppliers from Australia, Saudi Arabia, Mexico, and Jordan. The issue with those non-traditional suppliers is they have abundant DAP production capabilities, but they have very limited MAP supply capabilities. That's why we've seen that in the past calendar year, NPS and then DAP imports have jumped quite a bit year over year, but MAP imports were down more than 30%. Again, largely because of the supply restrictions and limited operational capabilities from those non-traditional phosphate suppliers. And going forward, I think we're going to continue to see these trade pattern changes where US will continue to get more tons from those non-traditional phosphate suppliers. And also we're going to have a pretty tight MAP supply situations, and MAP will continue to trade at a wider than normal premium over DAP going forward. Just quickly, last slide, I want to quickly talk about the raw material cost for phosphate operations. And as you know, like ammonia and sulfur, those are two major feedstocks for phosphate operations. And then both prices have increased quite tremendously throughout 2021. And on top of the very tight fundamentals we already discussed for the phosphate markets, I would say these high prices for ammonia and sulfur will also continue to support a very strong floor for phosphate operations going forward. So that's just another thing from the cost production standpoint, what has been supporting the global phosphate prices out there. With that, I think that largely wraps up my further portion of the presentation as well. And I think Mark and I will be more than happy to answer any questions if you have out there.
Well, thank you, Mark and Yao. A lot of information, a lot of good information. I do want, before we get into the questions, we did submit for a CEU. If you could check the chat, we submitted for CEUs for this particular session. They will ultimately be approved because we've done sessions like this in the past, but we have not received our QR code yet. So if you could, please drop your name, your first name, your last name, and then your CCA member number in the Q&A box. That way, nobody else will see it. The only people that will see it will be the panelists, and then we'll share that information and make sure you get CEUs for this particular session. We've got Marks, but anybody else, if you want CEUs, please submit those in the Q&A box. That way they're hidden from the rest of the group. We've got a couple of questions. We'll see how comfortable you are answering the first one, because it isn't necessarily just a marketing question. It deals with Nutrien's response to the changing market. I'll just start with the first part of it. Is Nutrien planning to ramp up production significantly to meet North American demand?
I can give my 2 cents first, and Mark can probably tune in if there's anything additional to be made. I would say absolutely yes. And then as I mentioned, touched in my presentation, 2021, as soon as Mosaic, the potash market has been pretty tight, in particular, given a slower ramp up as some of the projects in Russia. People were anticipating more tons out of Russia at the beginning of this year, but because of the slow ramp up of their greenfield project, Eurochem, they had a very limited additional production this year. And also Mosaic, when they had that instance of K1, K2, potash mine decided to shut down those mines earlier than expected. We as Nutrien instantly, we decided to increase our production by about 1 million tons, just to meet the supply gap in the marketplace and also meet the increasing demand from our customers. And talking to the commercial and then also the production team from our potash business, we know that it's not an easy process. It's not an easy thing to just quickly ramp up 1 million tons. additional production there. That requires a lot of effort, a lot of planning for the potash team to get the right amount of people and the right amount of staff on site, and also get the right amount of equipment on site to achieve that. And then for 2022, I think we are prepared. I mean, everyone, as I mentioned, in the potash space is limited by how much they can bring on. But as Nutrien, I think we are prepared. If the supply will be disrupted from BPC, we'll try our best to increase our production there. I don't know how much we can do. I mean, again, that requires a lot of effort, getting the right amount of people and also machinery on site to achieve that. But I'm pretty sure we'll be looking at the supply and demand situations on a constant basis and make our decisions on increase, like see what we can do to increase our production and then do our share to increase to meet the increasing demand from our customers. And then on the nitrogen and phosphate side, very similar situation. I know in a tight situation, particularly out of Europe, seeing those massive numbers of shutdowns and curtailments at the moment. I know we've done some brownfield projects at our sites at Geismar and some other sites to increase our product availabilities and flexibilities as well to meet the increasing demand from our customers in the United States for different type of product. We can talk about ammonia, urea, UAN, and DAP, MAP. We are doing our share to increase our production and also flexibility in terms of the products or models, downstream products, to meet the increasing demand from our customers. So absolutely, we're doing our best to meet the market gap in there. And Mark, I don't know if you have anything to talk about. I think they talk about maybe chemicals or seedings or.
Yeah, sorry, on the chem and seed side for sure. I think our ag solutions team is working hard to procure as much as they can of the key products and look for substitutes where they need to, particularly on the chem side, so that as we get into spring, our customer will have the inventory to support our customers' needs come springtime, and then we'll have the right product lineup to get them through the 2022 growing season.
And also, yeah.
Sorry, go ahead, yeah.
Want to add one more thing, just reading the questions. Like on the logistics side, I mean, we've had a lot of logistic issues, or not just in the US, but around the globe, given the very strong demand for many bulk commodities and also the increased freight costs for many regions. I'm not directly involved in all the transportation details, but I mean, having some of the conversations with our transportation group, I know they're looking at the issues on a regular basis and then trying to improve our ability to deliver the product to our customers at the best time by having those conversations with some of the big suppliers like CN and CP and some of the railway companies out there. So I'm pretty sure they're looking at the situation on a very regular basis and trying to solve all the problems they can. But still, you know, when you have some of the weather-related issues, I mean, you just can't avoid those, you know, the flooding and some of the weather-related issues out there. But I'm pretty sure, and I know they're trying their best to look at all those problems.
Yeah, I was going to avoid that second half of that question because that gets very specific into what our plans are with regard to what are we doing on the TD&L side to make sure we can get product in position for customers. This will be the last question. Before I ask it one more time, we're not able to get our QR code for the CEUs. Please, for those who've already submitted them, I've copied them. I have them. I will get those submitted. If you do want your CEUs, put your first and last name and your CCA member number in the Q&A box, and we'll make sure that you get credit. And this will be the last question for you, gentlemen. This is a really good one. This is a question I fielded a couple of times, but I'm interested in your answers. Do you see energy prices changing at all with increased renewable natural gas developments in the EU and in North America? And then ultimately, how will that impact fertilizer price?
I can give my 2 cents. I think it's, you know, we do believe for the short term, I mean, you know, it's really difficult to forecast the natural gas prices in the long run because there are so many dynamic factors out there when it comes to supply demand. But in the short term, I believe that it's more related to the political environment right now, given the supply, particularly supply situations out of Russia. Right now, they have very limited LNG supply from Russia to Europe. That's what has been causing the spike in the natural gas prices. But going forward, given the renewable energy development in some of the countries, we believe there could be a stronger demand for that sector. And but still, the supply is only one part of the equation, but demand is also a part of the equation. Particularly when China, they're talking about using more cleaner energy going forward, and natural gas will be the way to go. And we know China is really short of natural gas. And then similarly for some of the Japan, those regions as well, there will be increasing demand from those jurisdictions as well. So I think in the short term, we think natural gas prices will be high, largely driven by the very tight supply out of Russia. And then when I say political related issues, is really because of the Nord Stream 2 pipeline, which involves a lot of political, and that really has been deterring some of the gas supply from Russia to those European countries. But in the long term, I would say, yeah, the continuous strong demand from those developing countries, particularly in China, looking for cleaner energy, and then also the renewable supply that'll continue to play in the factors determining the natural gas price going forward. But I would say it's a very dynamic situation out there. It's hard to predict natural gas prices in the long run, I have to say.
It's almost as difficult as predicting commodity prices in 2023 right now, because I've gotten that question before too. Mark, did you have anything else to add as we wrap up?
The only thing I'd maybe add to that is we're certainly entering an environment where there's really renewed interest from governments all over the world around improving the greenhouse gas emissions globally, and really putting an effort into renewable energy alternatives and investing in those spaces, whether post COP26, we're seeing it from all kinds of Western governments, but also in China. And I think that our view certainly is that this push towards renewables is here to stay and very real. And I think it's going to create some dynamic changes into the energy environment. What the prices look like going forward as a result of that, I wish I had that crystal ball, and I think Yao does too, but certainly something we're going to keep our eyes closely peeled to as a result of this dynamic environment.
Yeah.
Well, go ahead, Yao, sorry.
I didn't see the question, but there's the second part. Do you see this affecting flatter prices? In the short, I think I touched that on my presentation. In the short run, I think that kind of the high energy prices in Europe and Russia and in China, that would support the short-term flatter prices when it comes to production cost standpoint. And then, in the long run, I think the flatter prices will still be largely determined by the global supply and demand fundamentals. So really, when you look at flatter prices being supported or being pressured, is normally we talk about supply demand still come to at the first place, determining flatter prices. But the production cost will provide a kind of the floor prices for flatter prices operation, if you will. But I would say for now, as you can see, a lot of the flatter prices are traded significantly above the production cost, which means that the supply demand fundamentals, the tight supply demand fundamentals, is a major driver at the moment.
Good. Then my answer has been correct. It's complicated. There's a lot that goes into it. Gentlemen, we appreciate your time. For all those who attended, we are so appreciative that you took an hour out of your day to join us on the webinar. We hope you found the information of value to your operation. I'm going to leave this open for another couple of minutes. For those of you who haven't had a chance to submit your name and your CCA number through the Q&A, make sure you get that done. Thank you, Yao. Thank you, Mark, for your time. Thank you for the information. We hope you both have a Merry Christmas and a happy holiday season. And we'll look forward to maybe a year from now doing this yet again. And I'm sure that the economic situation will be dramatically different from where we are today. Take care, everyone.
Thank you. Bye.